Now, the first step is figuring out how much house can you afford. And that's the end process of that is you're going to get like a pre-approval letter, and then that's going to allow you to go shopping for a home and look for your home. But before you get to any of that, my honest suggestion is in getting a pre-approval letter, you need to start talking to loan officers, lender representatives. And the best way, honestly, to do that is find a good realtor, because a good realtor is going to have a bunch of lenders that they work with who they already know, who they know have a good reputation, who are going to serve your needs the best way possible. And then they're also going to be able to help you through every other step of the process of, finding out. They're going to already know, the kind of homes you might want, the neighborhoods, how to close the deal and all that kind of stuff. So the first thing I suggest is actually get a realtor so that you can start talking to some loan officers. That will be the first. Let's assume at this point you've spoken to a realtor, they put you in touch with some lenders. Now you've spoken to some lenders. Well, the first thing they're going to ask you to do is to bring in a bunch of your personal financial documents. Usually what they're going to ask you is for 2 months pay stubs. They're going to ask you for 2 months bank statements, a tax return, and that's usually going to be the first things that you need to get ready. So start collecting all those documents. That's the first step to finding from a lender. Is going to then find you, if they can pre-approve you for a certain amount. They're also going to want to know your credit score, and there's some other things that will go into debt to income ratio. They're the main things you need to do. So we're going to go over that a little bit more in the next video. So that's the next step in the process, gathering your financial documents. All right. Okay, so we're doing a video series on finding out how much house you can afford. And here's a quick tip. When you go to find out, getting a pre-approval letter to find out how much you can buy a house for, what you don't want to do is go to a whole bunch of financial institutions and ask them all to, do like a credit score pull for you. They call it a hard pull and a soft pull. It means, if you go to a bank and you give them all your financial information and they get you a credit score, that's actually, in a strange way, it actually affects your credit score in a potentially negative way. At that particular moment in time, you might have your credit card maxed out, and when they pull that credit score, that will inversely affect your credit score. So what you want to do, like I suggested in previous video, is work with a realtor who's got some loan officers, some lenders that he knows, and you can work with one of them, and they can do it in a way that it won't adversely affect your credit score, and that's really important. That's what we're going to talk about next, that you need to think about in a credit score. First is your payment history. The first part of a credit report looks at, how have you done in payments, and a tip here is always make your payments on time. The second part of your credit score is how much you owe. If you're maxed out, for example, on credit cards and whatnot, it's not going to be good on your credit score. That's a tip. Don't max out your cards to more than 50%. And the third part is, your credit history in terms of how long have you been paying credit. So the thing that you want to do here is keep your credit history. If you have cards, don't close cards that you're not using, for example. Credit history is really important. The next thing is how much new credit do you have. So don't go making applications for new credit cards, for a new car loan right before you want to go get a mortgage, because that's going to decrease your credit score. It used to be that you'd often have to come up with about 20% of your purchase price for a down payment. I had to do this when I got my first home, but that's not true anymore. There are many programs out there where you can come up with as little as, say, 3%, but you do, however, need to come up with a down payment. You need to learn to save, and the 3 easy steps for learning to save is, first of all, put a picture to it. Picture of a home, up on your fridge, or so to remind yourself, what am I saving for? Every day you have a note of what you're saving for. Avoid impulse purchases. So if you see something you really want to buy, put the 10-day rule into effect. Say, I'm not going to buy that for 10 days, and see if you still want to purchase after 10 days. Many times you'll find you won't. And there's ways you can reduce your expenses by cutting out a few little luxury items. And that way you can come up with your down payment and get your dream home. There's a myth about buying a home that goes something like, if I have a real bad credit score, I won't be able to get pre-approved for a home loan. That's actually not true. And very quickly, the reason that's not true is, perhaps you do have a bad credit score. Well, firstly, there are a lot of programs out there that can help fix your credit score. For example, if you go to a really good loan officer, which a realtor can help you do, the first thing they're going to do if you do have a bad credit score is say, hey, we've seen all your debts and what you're paying, and they're going to prioritize debts that you should pay off and ones that you don't have to worry about. So that's just one example. When you prioritize, I'll pay this bill rather than that bill, it can really help your credit score, get better. So that is a myth about having a bad credit score. That can be fixed. The important thing is just to get the process moving, work with a good loan rep and a good realtor, and we'll get your credit score good enough to get you a house. Know how much of a down payment you need. Here's some tips for some great sources for getting that down payment. First of all, payroll deductions. If you've got a regular payroll, why don't you consider deducting a certain portion of that payroll every payroll period into a savings account? That's a great source for getting a down payment going. Next, tax returns. If you're getting a tax return, you should put all of that into a possible down payment. And next is also maybe you have a 401k. Why don't you deduct some money from your 401k and think of it really as you're taking money from one investment and putting it into another. And lastly, do some overtime work. Put a few extra hours in each week, and there's another source. Those sources will get you a serious down payment. About down payments and getting your down payment together, what happens if you just can't seem to get enough money for your down payment? Well, there's great news for you. There's a lot of, they call them DPAs, that's down payment assistance programs, and there are many programs like that right now that are offering up to $15,000 of assistance for first-time home buyers to put for their down payment. And often the way these work is that you'll end up maybe paying a little bit extra in your monthly mortgage installment, but they're going to help you, they're going to upfront the money for you so you can get your first home. So great news, if you can't get your down payment together, there's still ways you can get a down payment together with a down payment assistance program. So you're in the process of getting a pre-approval letter, which is going to determine how much home you can buy. We talked about, credit score, getting to a loan officer, getting all your financial documents over there. Another really important thing that's going to influence how much you can borrow is they call it the DTI, that's the debt to income ratio. And basically, in a nutshell, that just weighs, how much, debt do you have? You might have a car loan, you might have some other obligations you have to pay every month. And then how much is that against your monthly income? And the basic equation is, if the amount of debt that you have to pay is around 45% of your monthly income or less, you're in good shape. If it's above that, or if it's around 50%, you're not going to be in good shape. So what that means is you want to try to manage your finances to figure out, your monthly debt obligations, try to get them around 45% or less of your total monthly income. Now, what happens if you have a low credit score? Well, there's a lot of loan programs, for example, an FHA loan. That's specifically designed for a first-time home buyer. And what this program does, it allows home buyers who have low credit scores, for example, even as low as 500, to apply and get the loan. If you have a lower credit score, say between 500 and about 580, you'll need to put about a 10% down payment deposit on the house. If you have a score, a 580 and above, you can get as low as like a 3.5% down payment. FHA loans are a really good example of loan programs that exist out there for you as a first-time home buyer that can help you. On the one hand, if you have a low credit score, which can be a problem, or maybe you're having a problem getting a down payment amount together, it can help you with that also. Conventional loan is not a government-backed loan like an FHA loan, and it can definitely be an advantage if you have a good credit score, but that's the catch. You need a good credit score to get a conventional loan, and you also need to have a good DTI, debt to income ratio. Now, if that's the case, you're going to end up with a lower monthly mortgage payment. The better your credit score, the lower your mortgage payment will be. If you have a low credit score, you may not even qualify. Usually you need a credit score of around 620 or above to qualify for a conventional loan. And also, in this case, you can have a lower down payment. So conventional loans are really good if you have good credit, a good credit score, and a good debt to income ratio of less than, say, 43%. So let's talk about mortgage interest rates. There's two main kinds. One is a fixed mortgage interest rate, and one is an adjustable. That's called an ARM, an adjustable rate mortgage. And the basic idea is, your interest rate on your mortgage is going to determine largely how much your monthly payment is going to be. The higher the interest rate, the higher your monthly payment. And think of it as your rent, your mortgage payment, your monthly mortgage payment. And there's an advantage to getting a long-term fixed rate, like a 30-year fixed rate will mean you maybe have a higher interest rate slightly, but it's fixed, it will not change over the 30-year period of the loan. Or sometimes you get a lower interest rate at the beginning, but it's an adjustable rate mortgage, which means if, like right now in the economy, interest rates are being increased by the Federal Reserve, your mortgage rate will go up, and therefore your monthly payment will go up. I myself have a combination of both. On my place, I have a fixed rate for, say, 10 years, and then it goes to an adjustable rate for the second 10 years of the mortgage. So, one of the best loan types you can get if you qualify is a VA loan, Veteran Affairs loan. And the deal here, why it's so amazing, is first of all, there's no down payment. You don't have to come up with a down payment, and it's not based on your credit score. So, if your credit score is not great and you don't have enough money for a down payment, that doesn't matter with a VA loan. That's a really, really good option if you can qualify. Qualification usually revolves around 2 years of regular service or 90 days active duty service. There's different qualifications like that. So if that fits the bill, a VA loan is a really, really good option for a first-time home buyer because it's not tied to your credit score and you don't have to come up with a down payment. Hey, let's talk a little bit about your monthly mortgage payment and with a concept called amortization. And what this word means is basically your monthly payment, your monthly mortgage payment is at a fixed amount for your period of your loan, whether it's 20 years or 30 years or whatever. And a certain portion of that loan is going to be for the principal, which means actually paying off the amount of the house that you owe, and a portion of it is going to be to the interest, which is the money the lender is going to get back for giving you the loan. At the beginning of a mortgage, you're paying mostly interest in your monthly payment, a small amount going to the principal of what you owe. As you get towards the end of your loan, most of that fixed amount payment is now going to be going to the principal and less is going to be going to the interest. That's a traditional way that most mortgage payments work. Let's talk about mortgage insurance. So, for most mortgages you're going to take out, you're going to be required to take out what's called mortgage insurance. With a conventional loan, they call it private mortgage insurance, and with an FHA style loan, it'll be a mortgage insurance premium. And, conventional loan, that usually stops after you've reached about 20% equity or 22% equity. And in an FHA loan, it might go for more than 10 years of the duration of the loan. But basically what it is it's insurance for the lender that if somehow you default or you can't make the payments, they still get the premiums, the mortgage that you're supposed to be paying. So that's what mortgage insurance is about. You're going to hear those terms, PMI, private mortgage insurance, or a mortgage insurance premium. So that will often be part of the calculation of your mortgage payment.